Stories.com is reporting that a rising number of Canadians may be at risk of defaulting on their mortgages in 2023 due to the recent rise in interest rates. And at the same time, we're also seeing unaffordability become more and more of an issue in the rental market as well. Today, I'm going to cover who is most at risk for defaulting on their mortgages and how this is all connected to the inventory and pricing issues in the rental market. My name is Jessie McLellan, and I'm a realtor here in Oshawa, Ontario with the Lisa Abbott Team. If you enjoy this type of content and want to stay up to date on the real estate market, specifically what's going on in Durham Region and the GTA, then please consider subscribing to the channel and giving this video a thumbs up to help us reach more people like you. And if you have any questions about buying or selling a home in and around the Durham Region, or you just want to have a chat and get your questions answered about the market, you can book a call with me at a time that works for you using the link in the description. On January 25th, the Bank of Canada announced the 8th rate hike in 10 months. And raised the interest rate by 0.25%, bringing the overnight rate to 4.5%. For comparison, at the beginning of last year, that overnight rate was at just 0.25%. These rate hikes have had people speculating for months about the potential that they will cause many Canadians to default on their mortgage. So let's go over an article and see what stories.com has to say about it. Now, normally I wouldn't use an article that's more than a couple days old, but I thought that this one really touches on everything that I want to go over. According to this Stories.com article, variable rate mortgage holders have seen their payments soar over the last year, with some paying upwards of $1,000 more per month than they were in early 2022. Those up for renewal on a fixed rate mortgage in 2023 can expect to increase their monthly payments by several $100s. Now, although some homeowners may see increases in their monthly payments, theoretically, they have been stress tested at this rate and should be able to afford it, assuming that their income hasn't decreased and they haven't taken on any additional debt, like a big car loan, for example. So that could mean we see people really starting to scale back on other spending, and when Canadians start pulling back on other spending, it has other ripple effects in the economy. The article continues and goes into there's definitely going to be a rise in defaults in Canada. By the spring, we'll hear about more people who lost their houses. I don't think it will be a systemically dangerous level of default, but it's one piece in the puzzle that could drive Canada into a recession. It only takes a few forced sales in one area to pull property values down. The second part of that quote is usually the part that's always left out of the headlines. But he's right, and I think we will unfortunately start to see more people feeling the pressure and being forced to sell or default on their mortgages. But I think a misconception many people have when looking at this is that they assume that if people start defaulting, we'll see distress sales popping up all over and prices will fall rapidly. But from everything I've read and everything that we're experiencing now, I don't necessarily think that's the case. I do believe prices will be level or slowly trend downward for a little while, but I think the effects of increased payments for homeowners will have other effects on the economy, like I mentioned above, when people really start to cut their other spending, or the large impact it will have on the rental market, and I'll touch on that in a little bit, but I would love to hear your thoughts too, so don't forget to leave me a comment below. Butler pointed to several groups he says are particularly vulnerable to default, including people who have multiple properties with variable rate mortgages. Keep that in mind because I'll mention that in a moment. People with large balances on home equity lines of credit, and people who are involved with private mortgages and alternative lenders. According to the Office of the Superintendent of Bankruptcy, November 2022 saw the highest number of Canadian insolvencies since the onset of the pandemic. To mitigate the risks stemming from high household debt, Canada's banking regulator has proposed a number of new mortgage lending restrictions, including loan-to-income and debt-to-income restrictions. If implemented, the measures would limit what some borrowers qualify for. And those proposed lending restrictions would ironically push more people to private mortgages and alternative lenders because they would now qualify for significantly less with the options that the big banks would be offering to them if those changes came into effect. So I mentioned how this could cause a bit of a ripple effect. Monthly payments get more expensive, people cut back to afford their homes, businesses see sales and profits drop, that can then affect jobs, etc. Those are all possibilities. But one thing this is for sure going to affect is the rental market, and probably not in a good way. Not only does the rates going up affect owners of tenanted properties with variable rates and those who will be renewing this year, but this also affects the number of new rental units hitting the market. Every healthy real estate market has a certain number of rental properties available. And not only will this force many current landlords to pass the added costs on to the tenants if possible, because despite what some people might think, many landlords, especially in Durham Region, are cash flowing very, very little or not cash flowing at all. And the money being made as a landlord isn't necessarily in the rent you're charging, but rather in the equity being built over a longer period of time, which is why many can't afford to absorb these added costs and why many cashed out in February. But those added costs are also forcing future landlords who have purchased pre-construction properties to reconsider, as the numbers they worked out when they initially made the purchase are no longer applicable, and the numbers may not work for them now that rates have increased. And even if the Bank of Canada pauses their rate hikes and keeps rates exactly where they're at for the rest of the year, all of the owners of tenanted properties that have to renew this year will be feeling financial pressure from the increased payments as well. And they could be forced to either increase their tenants' rent if they are allowed to and it's not rent controlled, or sell the property altogether, which could take another rental unit off the market if it's not purchased by another investor. The future supply of rental units may be restricted as well, as many people who purchased homes with the intention of renting them out may now realize that the property they purchased a couple of years ago in a different market no longer works as a rental unit for them because of the current conditions. All of this can lead to current landlords raising their rent to help afford the added costs, plus it creates a lack of currently available rental inventory, and it decreases the number of rental units that would be hitting the market in the future as these new developments finish and the owners close on those properties. So we're kind of at this point where home prices aren't declining enough to allow some renters to transition into buyers, and the current conditions of the rental market are forcing people to look for cheaper accommodations, whether that's renting a smaller unit, renting a room, or looking further outside of the city, etc. But there are still plenty of first-time homebuyers purchasing properties and planning to purchase properties, and we're still seeing competition in those entry-level price points especially. So if you need help navigating a purchase or a sale, or you would just like to have your questions answered, use the link in the description and book a call with me at a time that works best for you. Thank you so much for watching. I hope you found this video helpful, and I'll see you in the next one next week. Bye!